Okay, guys, today we have to discuss a very interesting standard, and that is related to the effect of changes in foreign exchange rate, and the standard is IAS 21. Okay, this standard is basically dealing with the functional and presentation currency, and also dealing with the accounting for individual transaction in the foreign currency, and then translation of the financial statement of the foreign operation. Clear? So the the basic purpose of this standard is to give guidelines for dealing with the foreign currency transaction and the translation of the financial statement involving foreign operation. Clear? So this standard helps entity manage, uh, the impact of currency changes on their financial performance and position, and also reports uh, uh, that impact the currency changes on their financial performance and position. So it defines the functional and presentation currency and explain how to account for the foreign currency transaction. Clear? So, for example, a company in the UK. Let's say a company in the UK has a branch. Uh, there is a company in UK and has branch in US. Okay. So IS 21 guide how the UK parent company translate this US branch financial result into definitely the currency using sterling GBP. So they will convert or translate the dollar to the GBP. So this guideline provided by the IS 21, and the UK, the parent company will use the GBP, mean the sterling pound, is a presentation currency. Clear? So, what does we mean by the functional currency? What does we mean by the presentation currency? We have to discuss it here. You see here, functional currency, the currency of the primary economic environment where the entity operates. So this is the currency, functional currency is the currency of the primary economic environment where the entity operates. Clear? On the other hand, presentation currency is the currency in which the financial statements are presented. So mean presentation currency is the currency we are using for the presentation purpose, for presentation of the report, while the currency, functional currency, the currency of the primary economic environment where the entity operates. Clear? And what about foreign transactions? So foreign transaction means the transaction conducted in a currency other than functional currency, then we call that. Let's say your functional currency, mean the where you are operating, is dollar. Okay, and you did some transaction in pound. So this is called foreign transaction. And regarding and translating this foreign transaction to your functional currency or to your presentation currency, then you have foreign operation. Foreign operation means that translating, let's say here, let's say you have entity and that entity operating in foreign currency. Okay, translated in foreign currency and to the parent company. Clear? So that will be your foreign operation. So translating the financial statement of the entity that are operating in the foreign currency and to the parent company, mean to the presentation currency. So you will call that as foreign operation. Clear? We have here example. Let me show you. Okay, this is the example. A company based in US on revenue primarily in US dollar would use US dollar as its functional currency for its financial records. So, I mean, a company is based in US, and definitely in US they are dealing in dollar, so the functional currency will be the dollar for this company. Clear? Now, what we have learned that the entity records its day-to-day financial activity in its functional currency and may present its financial statement in different in different presentation currency. Okay, so the functional currency is determined by the economic environment in which the entity operates, while the presentation currency is chosen by the reporting entity for the reporting purpose. And there are some criteria for both to determine the functional currency and the presentation currency. Now let's discuss about the factor determining the functional currency. Okay, so here we have two types of factor. One is primary factor and the second is secondary factor. Okay, primary factor and the secondary factor. Clear? Okay, first we have to discuss what does we mean by the primary factor that have indicate, or you may say determine, the primary currency. So currency influencing sale price for a good or services, then that will indicate that this is your functional currency. Currency determined by the competitive force and regulation in the country, and currency influencing labor, material, and other costs of providing goods and services. What does it mean? The currency that mainly influence sale price for a goods and services. This means that this is the currency in which the company primarily set and determine the price of its product or services. Okay, so that is the currency sale price, influencing the sale price for the goods and services. For example, let's we have a smartphone manufacturer in Germany export phones to globally, but price them in US dollar because most of its sales are international, and then they are using USD dollar. US dollar, clear, is a stable global currency, so that we say in simple terminology that pricing depend on the international market, and second, the currency used to invoice the customer. So what does we mean by the currency influencing the sale price for the goods and services? This is very simple, that the pricing depends on the international market and the currency used to invoice the customer. So this means that influence the sale price for the goods and services, and that will be your functional currency. Now, what what does we mean by the currency determined by competitive forces and regulation in the country? So this means that this is the currency of the country where market condition, competitors, or government rules impact the pricing decision. So determined by the competitive forces and regulation in the country. This is we sample that the currency of the country with the market condition, which I told you, competitors, are the government rules, impact the pricing decision, that will be your functional currency. So let's say a local bakery, let's say in the France, set its price in euro because it competes with other French bakeries and must follow the French regulation. So that is you can say this, that is the functional currency for that bakery which is locally selling the bakery product in France, and they have set the price is euro. Clear? So that is the reason that this competitive force and regulation determine the price, the what we call it, the currency, and that is your functional currency. Clear? So And simple what we said that domestic competition and rules influences pricing and affected by the local market demand and supply. So that will be your functional currency. So currency, first we have discussed that currency that influences your sale prices for goods and services, that will indicate that the currency, that currency will be your functional currency. Then we have discussed that currency that determined by the competitive report, mean the other competitor and the regulation and the country determine the currency, and then that will be your functional currency. And the last one is the currency influencing labor. Currency influencing labor, then material. Wait, let me highlight it. Currency influencing labor, material, and other costs for providing goods and services. In simple word, we can say that this is the currency in which the company incur most of its cost. Okay, as such as wages, raw material, and operational expenses. So that will indicate that this is your functional currency. So currency influencing labor, material, and other costs for providing goods and services. So this means that the company incur most of its costs, that is maybe wages, raw material, or operational expenses. So that currency will be your functional currency. For example, let me give you an example. A clothing company operating in, let's say, in Bangladesh, and sources its material and pay wages in Bangladesh. That currency is taka, I think. Is this is the local currency where most of its expenses are anchored. So that will be the taka will be the functional currency for that Bangladesh company. This means that determine the cost structure may different from the currency used for pricing. So there may be a situation where the cost, you are using the different currency for cost and different currency for pricing. Clear? So there you will have to wait of which one is the which indicator give you the conclusion that this is the functioning currency or not. So what we have discussed in this primary factor, we have discussed that currency for sale prices, we have discussed currency for competitive forces, and then we have discussed currency for cost. So currency for sale purpose reflect the market where the sale occur upon a global or dominant currency like US dollar. Currency for competitive forces reflect the local market dynamic, usually the local currency. And then currency for cost reflect the country where the production or services occur, typically the local operating currency. Clear? So we have discussed the primary factor, which will indicate that this is will determine that this is the functional currency. The secondary part, if this primary factor is inconclusive, then you will have to look at the secondary factor. The secondary factor here we have here is a currency used for financing activity. So whatever currency you are using for financing activity, that will be your functional currency. And the second point is secondary factor is the receipt from operating activity or return. So whatever the currency you are using for retaining the receipt from operating activity, that will indicate that this is your functional currency. Clear? Okay, let's move on. We have okay, there is some other point which you need to remember, that is foreign subsidiary. This is allow for the foreign subsidiary to using the parent function currency, and that foreign subsidiary operate is an extension of the parent. The second is high level of transaction with the parent, and the third, the cash flow are readily available for remittances to the parent. Okay, so in some cases parent subsidiary can use the parent subsidiary can use foreign subsidiary can use the parent functional currency. And the reason behind this is that foreign subsidiary should operate as an extension of the parent company. Second, the foreign subsidiary have some high level of transaction with the parent. Clear? And the third one, we say that the cash flow are readily available for remittance to the parent. Clear? Okay. Let's move on. We have another concept. Okay, now we have to discuss the accounting for transaction designating in a foreign currency. So we have, there is a recognition criteria that what you will do when you are recognizing. So initially, when there is a transaction in the foreign currency, then what you will do first, initial regarding what you will do, you will the transaction in the foreign currency must be translated. So you have to translate that into your functional currency. First thing you have to remember that the transaction in the foreign currency should be translated into your functional currency. Clear? Now what rate you will use for the translation? So you have two rates: spot rate on a transaction rate. If you have spot rate transaction rate, then you should use this one, or average rate over a period if the rate are stable. So if the rate are stable, then you are allowed to use the average rate. Okay. Then you have after initial recognition, after initial recognition, there is cash settlement. So when the cash is settled, that time you have to use the spot exchange rate on the settlement date. And the difference between the initial transaction, mean the initial transaction rate, and the settlement create exchange differences, and that should be charged to the profit or loss. Okay. For the settlement, now you see here. Okay, wait a minute. Here you see. So what do you do with exchange differences? So recognize in the profit or loss during the period they arise and can be classified operating income or expenses, or another heading in the profit or loss. So what we have studied for the first accounting recognition, what you will do first, you have to translate. Okay, and for translation, what you will use the spot rate or average rate, and then in settlement, cash settlement, if there is settlement, then you will use the spot rate or the rate at the settlement date. Clear? Now if there is differences between the initial transaction rate and the settlement date, then that will be charged to profit or loss as exchange differences, and that may be profit or loss. Clear? Okay, now we have example. I will show you here example. Okay, let me minimize it. Okay, here. This is the example. You see, here we have an example that a sale. Wait. Okay, here you see. A sale worth this amount is recorded when the spot rate is $1 is equal to 0.8 euro. This is a functional currency. So you have to translate this dollar sale to your functional currency, and the functional currency is euro. Clear? Okay. Now initially, what you will do initially regarding this should be translated using the spot rate, that is $1 is equal to this one. This is your spot rate, is written here, spot rate, and this is your initial recognition. Now upon settlement, the spot rate is this one. Okay, the spot rate is you see increased from 80 to 85. So cash received on this date will be 250. Sorry, 850. Okay. So you will use this rate, spot rate, initial recognition, use transaction date, you will use that spot rate, and then on settlement, then you will use that spot rate on settlement date. Where there's a differences between this one and the differences is 50, and that should be charged to profit or loss, and we call that as exchange differences. Clear? Okay, good. Now, what do you do when you have some scenario like this? That the settlement is not full settlement, and there is some item which is remain, and this is the remaining at the statement financial position. Then what do you do with that? So for that, you have to categorize that whether it is a monetary item or non-monetary item. Then after doing this, you will be able to treat it properly. So here if you see treatment of year-end balance. So treatment of any overseas item remaining in the statement of financial position at the year end depend whether they are monetary item or non-monetary item. So if you have monetary item, then what you will do, and if you have non-monetary item, then what you will do. By monetary item, we means that cash, receivable, payable, loan. Okay, you see cash, receivable, payable, and loan. While non-monetary item, the item that is a non-current asset, inventory, investment. This is the non-monetary item. Clear? So what do? You will the monetary item should be retranslated using year in. You see here, retranslate using closing rate year in exchange rate. While in case of non-monetary item, that should not be translated. And if the item is carried at fair value, then should be translated on the date it was determined. So let me show you here. You have two things. If you have balance, then you have two things. The first one is, if you see here, let me show you, the treatment of the year-end balance is depend on whether the item is monetary item or non-monetary item. So if the item is monetary item, means cash, receivable, loans, then should be retranslated using the closing rate year-end exchange rate. If the item is non-monetary, then, for example, non-current asset, inventory, or other, should not be retranslated, but translated the exchange rate when the fair value was determined. So, if you have monetary item, then translate. Otherwise, no need to translate. Clear? So, monetary item like receivable. You see here, the question is here. Monetary item. Receivable is monetary item. This is the 10,000 euro at the year end. That should be retranslated using the closing rate. Okay, let's say closing rate is this one. If you retranslate this monetary item, then the value worth will be 32,000. This is the translation of the monetary item. Now let's say if you have non-monetary item, for example, you have non-current asset purchase this amount, and this is earlier in this year, and now the rate is this one. So this should not be retranslated. If this is value at cost, if they are using the fair value, then definitely you have to translate using the fair value, the rate at the end of the year. So you see here, not to be translated, its main original value will be this one. Okay, 30. I hope you guys are understanding that what we are talking about. Clear? Now, okay. So we have here that if how you will deal that monetary item like payable must be retranslated in closing exchange rate, and item non-current asset inventory, which is non-monetary item, should be not retranslated. If the non-monetary item is carried at fair value, then it's translated in exchange rate. So that's it. That type of things you need to be in your mind that will be asked you in a paper, so you will tackle it easily. Clear? Okay, here when it's a new concept here. Let me repeat some concept. I will repeat again for you to make it more strong your concept about this. So when a sale is made in a foreign currency, it is recorded in the functional currency using exchange rate on the transaction date. Okay. Upon settlement, the payment is translated using the exchange rate on settlement date, and the difference is recognized in the exchange gain. What we have studied, we said if there is a transaction in the foreign currency, you have to translate that foreign currency transaction into your functional currency. Clear? And using the transaction date exchange rate, and that we call a spot rate. Upon settlement, the payment is translated using the exchange rate on the settlement date, and if there's any differences between the initial transaction rate and the settlement date, that should be charged to the profit or loss. Now here we have example. You see here. Okay, this is the example illustration for the exchange differences on settlement. Now On 7th May 2006, the entity with the functional currency is dollar sold goods to German entity for this one 48 euro. On this date, the rate of exchange is this one. So what do? You have to translate this amount using this rate. So that will be your translation to functional currency. Okay, now you see the sale is translated to functional currency using the exchange rate in place on the transaction date. So when you are translating this amount, then you will have receivable this and revenue this 15,000. Okay, so when you divide this with this, okay, now what on the settlement on 20th June 2006, a customer paid. Okay, now they have paid outstanding balance on this date. The rate of exchange is this, so you have again translate the amount into functional currency. So the settlement is translated to functional currency using the exchange rate on the settlement date, and that is 3.17. So when you translate this, then you will have 48,000 divided by 3/7. Then you will have cash, this one. The receivable you have recorded was 15,000. So it means you have you are getting 142 extra amount. That is your exchange gain. So that is your exchange gain and should be charged to profit or loss. It's very simple. Clear? Let's move on. Here we have the example of the your end remaining balance, that how you treat that. So if they are monetary items, and what you will do on 7th May 2006, the entity with a functional currency of dollar, okay, sold good to German entity by this amount. On this date, the rate was this one. Fine. Now you have to translate this, and you will get this amount. Okay. Now the settlement has not occurred until 31st July 2006, and the invoice had not been settled. So by the reporting date of 31st July 2006, and the invoice has not been settled, so it means that this is the remaining balance, and receivable is your monetary item, so you have to retranslate at the year end. Now on this date, the rate of exchange is this one. So you have receivable on monetary item, so must be retranslated into the entity functional currency at the year end using the closing rate, and the closing rate is 3.4. So when you are translating the receivable at the year end, therefore will be had is this amount. Why? Because if you translate this 48 with this amount, then the value will be this. Okay, what is the exchange differences? So before you have recognized that 15,000, and now this is down by 882. So that will be your expense, and that will be charged to profit or loss at the year end. Clear? Now, if the item is non-monetary item, so what do? There is no translation. We know that. So Olympic has a functional and presentation currency, dollar, and accounts for land using cost model. So you have to check it here. If there is fair value model, revaluation model, then you will have to retranslate. But if they are using cost model, so no need for retranslation. The property plant equipment on 1st July 2005, Olympic purchased plot of land at another country for this $1 million. So relevant exchange rate is this one. On 1st July you have to you have to use this rate for the translation of the land, and this one no need because we are not retranslating. So the land is initially recognized at cost that should be translated into functional currency using the exchange rate and the purchase date, and the land is therefore initially regarded as this amount because 1.2 million dinar divided by the exchange rate, and that is 4. So you will have $300,000. Land is not monetary item, and so therefore not retranslated and should be stay with the same amount of this one 300 million. And you know that land is not depreciable item, so we have not to depreciate it. Clear? Now what if there is a non-monetary item and with item with a fair value, then you have to retranslate it. Okay, so this is which is a pilot is a functional currency, presentation currency of the dollar. Okay, now is a dollar currency. This is the functional dollar currency. account for the land. Okay, this is again land using revaluation model. And on 1st July 2005, we purchased a plot of land in another country for this amount. Okay, on 30th June 2008, the fair value of the plot of the land is this one. Okay, so relevant exchange rate is on 1st July was this one. First you have to recognize at this amount and then retranslate at 30th June 2005 because it is the land is using a revaluation model. So land is initially recognized at cost. This cost should be translated using functional currency using the exchange rate, and that will be this amount. Clear? Now the land is non-monetary item, and cost is not retranslated. However, according to the revaluation models, the fair value has been determined and the valuation is dinar, and so too must be translated into functional currency using the exchange rate in place when the fair value was determined. So the fair value determined was 1.5 million. So you have to translate this, and that will be revalued to 500 from 300,000 to 500. So the increase of the carrying amount of land of this amount should be reported in revaluation gain and other comprehensive income, and the revaluation reserve will be included in other component of equity and state of financial position. So here we have some question that how you will deal with the such a type of question. You see here, describe how the above transaction should be accounted for in the financial statement of Butler for the year in 2000. So here the entity Butler is reporting date is this one. Functional currency is dollar. On 27 November 2006, okay, buy goods from a Swedish supplier at this amount. They are just purchasing their transaction, foreign transaction, on 19 December 2000. Butler pay Swedish supplier this amount in full. So the exchange rate was this one and this one. So what do? First you have purchased the thing, so you have to translate it using this rate. You see here, on 27 December 2006 must be translated using the exchange rate of the run. So transaction is initially recorded at this amount because this is the total amount you have to pay, and this is the rate, the spot rate, which is given here. You see here the date of transaction. The rate is 11.15, and the transaction was occurred. You see here the transaction was occurred for purchasing on 27 November 2006. Butler buys good. So in this rate, this amount should be translated into the functional currency, and that is dollar. Clear? Okay. Now the cash settlement is on this date. 19 December must be translated. So the cash is settled in full, and you have to retranslate that amount using the exchange rate at the cash settlement date. So when the cash settlement rate was 10.93, so when you translate this using this rate, then your payable be debit because you are getting money, and the cash will be credit. Okay, no, so you are paying the money, so the your pay will be decreased, your cash will also be decreased because liability will vanish, and there is expense of 585 dollar. Mean 585 will be your expense because before the rate was this amount, the actual recognition of the payable was this one, but you have paid this amount, so it means you have paid more than you have recognized, and that is your loss. So the exchange loss of this amount is risen, and this should be recorded in the statement of profit and loss. So the first thing you will do, first you will translate the transaction, and for that you will use the spot rate. Okay, now if there is settlement, then use the spot rate at the settlement date. If there is no settlement, okay, and the item is monetary, then you have to retranslate that using the closing rate. If that is the monetary non-monetary item, then no need for translation. Clear? This is very simple. Now let's move on. Another example we have here. You see an entity here, And okay, describe how the above transaction should be accounted in the financial statement of W waiter means for the year in 31st December 2007. Clear? So here an entity waiter has reporting date. This is the reporting date, 31st December, and dollar is its functional currency. Fine. Now they have borrowed in foreign currency that is K. Now the loan of this 120K was taken out on 1st January 2007. Repayment of this amount was made on 1st Jan 2007. Clear? So okay, what is the thing is here? You see here the functional currency is clear, that is dollar. Now this company, this entity have borrowed some money, and that money is in the form of another currency that is K, $120. And of this amount, they have pay 40. So 40 pay, it means that 120 minus 40, the remaining balance is 80. Clear? So the remaining balance is 80. Now on 1st Jan 2007, K is equal to this is the exchange rate. On post March, this one is the exchange rate, and this one is the 31st December 2000 is the exchange rate. So first you have to translate the transaction 120. You see here. Okay, let me. You see here. Okay. On first January 2007, the money was borrowed in this case, and this must be translated into functional currency using the exchange rate, and that is 2. So when you are multiply this amount, then you will have transaction recorded at this amount. Clear? Now you have transaction, you have recorded a transaction at this amount, and you have also created a loan of this. Clear? Now you have paid cash settlement. Cash settlement on first March 2007 must be translated into the functional currency using the exchange rate on the settlement date. So the cash settlement is recorded at this amount, and the loan is decreases, and the cash you paid, the cash also decreases by this amount. Clear? Now loan is monetary item, and that should be retranslated at year E. Okay, so if you see here, you have paid how much? 40, and the remaining is 80. So you have to retranslate this 80 using the closing rate. So loan or monetary liability, and at the reporting date, the remaining loan, this amount should be retranslated and using the exchange rate. Exchange rate should be the closing rate, and the closing rate is 3.5. So when you translate this, you write the closing liability of this amount. Now what you have to do, you have, there is some exchange differences, and that exchange loss should be recognized. Now if you see here, on 1st Jan 2007, 121 translated that was this 240 amount. Now on 31st, and okay, there is some you have some made some payment, that is 120. So if you remove this, then you will get 120. Now at the year end, your amount is 280. So the difference between the initial and the closing amount, that will be 160. So this is your exchange loss. The debit will be the profit or loss, and the loan will be credit. So loan will also increase by this amount. Clear? Okay, now we have another example here. Now here is example that describe how the above transaction should be accounted for in the financial statement of attended, mean A for the year ended 31st December 2000. If the land is measured at cost and the land is measured at fair value. So you have to remember, when using cost, there no need for retranslation because this is non-monetary item and should not be retranslated. While this will need to be retranslated using the closing rate. Clear? Okay, the first thing you will do, translate the transaction into functional currency using the spot rate. If there is any type of settlement, then you have to use the spot rate of that settlement date. Clear? Let's do it. Okay, entity attendant has reporting date this one and has a dollar is its functional currency. Fine. Now attendant purchase plot land ursi on first. This is transaction date. Now the entity paid for the land and the currency. This is the settlement date. Okay. Now they are paid for land in this currency. Or now the purchase cost of the land on the first this one, this should be 60,000 and should be translated into the functional currency, mean the dollar, and you will use this on 1st March 2000 rate. Okay, exchange rate. This is the exchange rate. Now the value of the land at the reporting date was this one. Fine. So this is increase in the value at the reporting date. No. Now what do you do if you are using this mean cost model? Then no. Then you have not to worry about this one because we are not concerned with this one. And if you are using fair value model, then you have to translate this 80 by using this 31st December 2000 exchange rate. Clear? Okay, let's check the answer. Here, you see here. Okay, the asset is initially recognized at cost. This asset means the land, and that should be translated using the functional currency and using the exchange rate on the purchase date. So the land is therefore initially recorded at $7,500 because when 80 is divided by 8, because this is the exchange rate. If you want to see the relationship here, you see here this is the 8. On 1st March 2008 is the exchange rate. Okay, so the land is non-monetary item, so should not be retranslated at the reporting date and should be remain at this amount. Clear? Now, if the land had at fair value, then valuation must be translated into dollars. So initially, you will recognize the amount by this amount, and then land should be retranslated at the reporting date when they are measured at fair value. So when you are translating this, then you have to use the land will be revalued to this amount. Why? Because 80,000 amount should be retranslated and the carrying amount of the land must be increased by 500 because before it was this amount and now this amount increased to 800 because the land is revalued. So when you are you see the value of the land at the reporting date is this amount. So this amount should be translated using this rate. Okay. So this is another question and very important question. Now let's move on. We have some other stuff here. Yes, this question is also very simple. You can do it by yourself. Here is another question. So now let's talk about the criticism. That what is the criticism over this standard? So let me wait a minute. Okay. Here. Okay. So here are some criticism on the on this standard. The first one is that lack of theoretical underpinning. Okay, lack of theoretical underpinning. What does it mean? It means that it's unclear why foreign exchange gain or loss on monetary item are in the profit or loss, but those on foreign operation in other comprehensive income. Okay, so it says that this is not clear that why they are charging the monetary item profit, monetary gain loss to profit and loss, and that of the foreign operation to other comprehensive. This causes volatility in the reported profit. Some suggest that foreign exchange gain loss should be go to the OCI if there is high chance of reversal. If there is chance of reversal, then it should be charged to the profit or loss. Okay. Another is long-term item. So retranslating long-term monetary item at the closing, it does not reflect economic substance. So this is another Criticism: foreign exchange gain loss on long term items are likely reversed before repayment, so some argue that they should be charged to the OCI. OCI instead of profit loss. Then you have average rate. IS does not specify how to determine the average exchange rate and the reporting period, leading to potential manipulation and the use of different average rates. So you can read this by yourself. This is simple. Just go through it. A monetary nominatory distinction, the difference between monetary and nominatory is unclear and need to be more classification. So thank you for watching, and this is the field of the standard.